Alrighty, y'all, we're getting close to the end here with Unit 4. We're looking at the financial market here, so the loanable funds market, money market, things like that, financial assets, stocks and bonds. So to start out with some of the big ideas here, the financial sector focuses on financial assets. So this is what normal people would call investments, stocks, bonds, mutual funds, things like that, and the relationship between lenders and borrowers. So when we're looking at borrowers and lenders, we're looking at banks as a good example here. Banks are the area where we're kind of combining these borrowers and lenders together. Bank balance sheet reports assets and liabilities. Assets are anything that are, have value, and liabilities are anything that we owe money to. So for a bank, if we deposit our money there, that's a liability for them. They owe us that money back. But the ways that they use that money is an asset for the bank. Right? If they give it out in the form of loans, they're going to get interest off that. If they buy, treasury bonds, that's an asset for them. They're going to get interest off that. So central banks use monetary policy to control the money supply, and through that, interest rates that banks are then giving out in the form of loans. So they use this monetary policy to either speed up or slow down our economy through this money supply. If money's more available, banks have more money to lend out, interest rates go down, investment goes up. Vice versa, if they lower the money supply, that makes it more difficult to get these loans and slows down our economy. So the three big tools that they have to control this money supply are the reserve requirement, which controls how much banks are required to reserve and how much they can lend, the discount rate, which is looking at if the banks borrow money from the Fed, how much are they going to have to pay the Fed, which also kind of directly determines our interest rates, and open market operations, which is the buying and selling of government bonds, which can push money into or out of the economy pretty easily. So the effectiveness of traditional monetary policy depends on the amount of reserves in the banking system. So if there's limited reserves and banks are lending out all the money that they can, these three tools are really effective because then they have to borrow money from the Federal Reserve. Then, if they raise or lower this reserve requirement, it is going to have an impact on these banks. If there's ample reserves, that's where we get into the interest reserves a little bit later on, but these tools aren't as effective because they don't have to borrow the money from the Fed then. All right, if we're looking at these terms here, the ease in which an asset can be converted into a medium of exchange, that's liquidity. So if you look at a checking account, very high liquidity. If you look at my house, very low liquidity. Both of them have value, but the ease in which I can convert them into cash is different. Interest-bearing assets often issued by the businesses or the government, that would be bonds. So you've got treasury bonds, which are done through the Treasury Department, and you've got private bonds or through businesses. Funds deposited in a bank that can be withdrawn without any penalty, that's our demand deposits. We know them as checking accounts. So those have really high liquidity. I can go and demand that money out right now if I'd like. The amount charged by a lender to a borrower, that would be our interest rates. So the riskier the borrower is, the higher the interest rate. And the amount of loans available, the amount of money to loan out available is going to impact these interest rates as well. 2 is kind of tricky. Why are the interest rates and bond prices inversely related? So if interest rates go up, the demand for existing bonds goes down. So if I have a savings bond for my nephew at 3% interest, and interest rates right now go up to 7%, no one's going to buy my savings bond from me. But if that interest rate goes down to 1%, now my 3% bond looks a little bit more appealing. So if interest rates are high, the demand for existing, I think it should say existing in front of it, but for some reason College Board doesn't, the prices for existing bonds goes down. And if interest rates go down, the price of existing bonds go up. All right, if we're looking at the equation for the real interest rate, we're looking at the real interest rate equaling the nominal rate minus inflation. So if I take out a savings bond, or let's say a loan with let's say a CD with the bank for 5% interest, and inflation grows by 2%, my real return would be 3%. So the real return is adjusted for inflation, just like real wages or real GDP are. So if our real interest rate is 4% and the nominal rate is 7%, that means that we must have had 3% inflation. So on paper, my investment was worth 7%, or my asset, I should say. It lost 3% of its value, so the real interest rate would be 4%. If my nominal rate was 4% and the real interest rate was negative 1%, that must mean that inflation grew faster than this nominal rate. So my inflation rate would have been 5% there. So on paper, I made 4% more money, but that money lost 5% value. Real interest rate's 1%. Now, if my nominal rate's 6%, and inflation is negative 2%, that means that prices went up. So inflation didn't grow, inflation went down by 2%. My real interest rate then would be 8%. So on paper, I gained 6% value. That money is worth 2% more because inflation went down. So the real interest rate would be 8%. Now, if my inflation rate is 5% and my real interest rate is negative 3%, then my nominal rate would have needed to be 2%. So on paper, I would make 2% more money. Inflation grew by 5%, so my real return is negative 3. So what we see here, when actual inflation is greater than expected inflation, the real interest rate will do what? So if the bank thinks that inflation is going to be at 3%, then they're going to charge more than that, right? But if that actual inflation rate is higher, the real rates are going to decrease because the banks aren't making as much as they thought they were going to. So if we're looking at the functions of money here, like what money does and what money is, a couple things need to be true, right? It's got to be able to be used as a medium of exchange, meaning that people, everybody accepts it. We all have a general idea of what it's worth. We can trade things using that money as a middleman, right? That you can trade your time, at your after-school job for a t-shirt, right? So you're putting in your time, it's worth money, and then you take that money and you can buy the t-shirt with it. So you're trading your labor for that t-shirt, but we're using money as that middleman. It's got to be able to store value over time, right? That if that money loses its value, there's no point in investing in it or purchasing it. And this unit of account just means that it's divisible and that we could break it up into chunks or build it up. Why are assets like cash and checkable deposits considered money, but bonds and real estate are not? It's because of liquidity, right? The first two, the cash and the checkable deposits, have high liquidity. You can go and use your debit card, which would be the checkable deposits, or your cash at the grocery store. But I couldn't use a savings bond or my house when I go to buy groceries. There's no liquidity or little liquidity to those things. So these would be considered money because they're completely liquid. You can go and spend it. So if we're looking at M1 and M2, M1 would be completely liquid, right? Your cash, coins, checks, debit card, all of those things that you could go and spend with. M2 would be what we call near monies. That would be like a savings account or a CD. They have value, and it'd be pretty easy to convert them into cash, but they're not actually cash. You can't go and use your savings account at the grocery store. All right, for 4.4, we're looking at the banking system now. This fractional reserve banking, the idea behind it is we deposit our money into a bank. They're required to keep a fraction of that, and then they lend out the rest of it in the form of loans. That lets us create demand where it wouldn't be otherwise. Now the difference between required reserves and excess reserves, required reserves, it's kind of in the name, must be held. The Fed forces banks to hold on to a certain amount. The excess reserves can be lent out, either to the government in the form of loans, or to individuals, for like a home loan or a car loan. So the excess reserves, the banks can do whatever they want with. The required reserves, they've got to hold on to. I realized that it's not on the screen. So the required reserves, they've got to hold on to. The excess can be lent out, or they can buy treasury bonds with. Now, if we're looking at this money multiplier, let's remember that it's 1 over the reserve requirement. The higher that reserve requirement is, the less the money multiplier will be, because banks can't lend out as much. The lower that reserve requirement is, the higher the money multiplier is, because banks can lend out more and more. So will the money multiplier increase or decrease if banks hold more excess reserves than expected? So again, if banks are holding on to that money, it can't circulate throughout the economy. So if banks are holding on to more, the money multiplier is going to go down. It's going to decrease because that money will circulate fewer times if they're holding on to more than they need to. All right, so now we're getting into the bank balance sheets and the assets and things like that. So let's take a look there. Give me 1 second. So if we're looking at this bank balance sheet, assets are things that we own that have value, and liabilities are things that we owe money to. If we're looking at this bank balance sheet, if you deposit 20 grand into a bank, that's a liability for them because they owe you that money back. But what they do with that money would be an asset. The bonds, the loans, right? Those are things that can earn them money. All right, so 13. If the required reserve rate is 10%, what are the current required reserves and excess reserves of Bank X? So we're looking at the required reserves and the excess reserves. It's just saying that there's $5,000 total in reserves. So if there's $20,000 of demand deposits and the bank is required to reserve 10% of that, 10% of 20 grand would be $2,000. So that would be our required reserve. They're required to reserve 2 grand, and so the other 3,000 of that would be excess reserves. What is the maximum possible increase in the money supply if Bank X loans out all their excess reserves? So here we go back to total change equals the initial change times the multiplier. All right, so if they're loaning out all these excess reserves, the $3,000, all right, we need to figure out our money multiplier. If it's 1 over the reserve requirement, the reserve requirement is 10%, so 1 over 0.1 equals 10. So there's a $3,000 increase in the money supply because that's what they're lending out. And note that it's not $5,000, right? So the $5,000 are the reserve, but only $3,000 of that can be lent out. So $3,000 is lent out, money multiplier is 10, so the total effect then would be $30,000. Assume a customer deposits $5,000 in the bank. Would the money supply initially increase, decrease, or stay the same? It would stay the same because the money they had in their pocket is money just as much as that demand deposit is. If I put 5 grand into a checking account, then that checking account is just M1 as the money is. Both can be spent immediately. So there would be no initial increase in the money supply. There would be eventually when they lend out the excess reserves, but we need to do the math on that in just a minute. So after the $5,000 deposit, calculate the new total demand deposits and excess reserves. So the demand deposit was $20,000. We deposit $5,000 more, so it's $25,000 now. The new excess reserves. So we deposit $5,000. The bank is required to keep 10% of that, or $500, which means the other $4,500 would go into the excess reserves. What is the maximum possible increase in the money supply from only this $5,000 deposit? So total change equals the initial change times the multiplier. So again, a lot of people would put $5,000 as the initial change, but that's not the initial change, right? That $5,000 is just going from my pocket into the bank account. It's still M1. But the money that can be lent out, these excess reserves, the $4,500, that is new money, right? If you take out a $4,500 loan to fix your car, that is added into the money supply. So the initial change is that $4,500 that they're lending out there. All right, the money multiplier we said was 10 earlier because the reserve rate is 10%. So the total effect on the economy would be $45,000. All right, let's see what's next. All right, so our money market graph here. The money market graph shows the supply and demand of money and how it sets the equilibrium nominal interest rates. So this is just looking at basic interest rates. The more money is available, or if our supply of money goes up, nominal interest rates go down. If our supply of money goes down, nominal interest rates go up. The banks later adjust it for real inflation, right? So if the nominal interest rate is 3%, but banks think that there's going to be really high inflation next year, then they're going to change their rates based on that. That's why the money market graph is using nominal interest rates, and that loanable funds market is using real interest rates. So we're looking at nominal, the quantity of money here. What's the difference between the transaction demand for money and, we'll do this one in just a second, transaction demand for money and the asset demand. The transaction demand for money is looking at how we use money to buy things, right? That if our economy is growing and we need to purchase more goods, we need that money in order to be able to do that. So it's looking at money as a medium of exchange. The asset demand for money is looking at the relationship between money and interest rates. So the asset demand for money, if interest rates are high, the demand for money is going to be low because people would rather put their money into assets. If interest rates are low, people would rather hold on to the money. Explain why the supply curve, supply of money is vertical. It's because it's set by the Federal Reserve. It's not based on interest rates at all. So if we're drawing out our supply and demand of money here, our demand curve is downward sloping because if interest rates are high, our demand for money is low. If interest rates are low, then demand for money is high. Our money supply is completely inelastic. It's set by the Federal Reserve and it's not based on interest rates. And then we would have our interest rates here. I'll call it IR1. All right, the last little bit, and we'll get into each of the specific tools in a little bit more detail, but we're looking at the tools of monetary policy here. So if we're looking at the difference between monetary and fiscal policy, monetary is dealing with the money supply and is controlled by the Fed. Fiscal policy is dealing with taxes and spending and it's controlled by our government, Congress and the President. So completely independent from one another, different sets of tools that they have. Monetary policy is a lot more effective. It takes effect immediately. This was a question that you all struggled with both on the quiz and the test for this unit, the difference between the discount rate and the federal funds rate. The discount rate is when banks, like let's say Bank of America, borrow money from the Fed. The federal funds rate is if banks borrow money from each other. Like let's say Bank of America borrows money from Wells Fargo. Similar, but they come about in kind of different ways. So if you go to take out a home loan from Bank of America and they have to borrow it from the Fed's going to charge them interest on that. Your interest rate is going to be higher than that. This federal funds rate is kind of more of a window. It's a range of interest rates. So Bank of America could borrow money from Wells Fargo, but there's not one set interest rate for the entire country. Each bank is going to ask for different interest rates depending on how much they have to lend out. So this federal funds rate is a lot quicker. It's when banks borrow money from other banks. All right, and this last part is kind of asking some cause and effect questions. How would each of these changes to monetary policy affect our money supply, our interest rates, and investment? And again, with investment, we're not looking at stocks and bonds here. We're looking at businesses. So businesses would rather make an investment at a low interest rate because that's money they're paying back. If I'm, Sam's Club, I'm more likely to take out that business loan and expand if the interest rates are low. So if the Fed increases the reserve requirement, banks have to keep more money and they can lend out less. Our money supply goes down. If our money supply goes down, interest rates go up. If interest rates go up, businesses borrow less money. If the Fed or the central bank buys bonds back from banks, the banks now have the money, their money supply goes up. If our money supply goes up, interest rates go down. If interest rates go down, businesses borrow more money. All right, this would be the opposite here. If we decrease the reserve requirement, banks can lend out more, which drives down interest rates, which increases investment. If we raise the discount rate, it's more difficult for banks to borrow money from the Fed. Our money supply goes down, interest rates go up, investment goes down. You can see kind of a pattern here. If the Fed sells bonds, it'd just be the opposite of up here. Now the banks have the bonds and they have less money on hand, which pushes up interest rates and it decreases investment. And then if we decrease this discount rate, like we did during the pandemic, down to zero, the banks can borrow freely from the Fed, pushes up the money supply. It makes it easier to get loans. Interest rates go down, and so business investment goes up. So it's all just a big game of cause and effect here. All right, we'll pause it here and take a look at the second part of Unit 4 in just a little bit.